Let me just say a few words about the issue of non-bank financial institutions and the shadow banking sector. This is an incredibly hot topic around the world, and clearly so in India. The term shadow banking was actually coined by an economist called Paul Mukherjee in 2007, and it's a sort of catch-all phrase that refers to financial sector activity which occurs outside the regulatory perimeter, outside the regulated banks. And that includes a whole array of financial products which are outside the purview of regulation. And not surprisingly, after the financial crisis in 2007, when the regulatory perimeter grew and the amount of regulations that banks were subjected to grew, much financial sector activity migrated to the shadows and went outside the regulatory perimeter where they had more flexibility. Shadow banking sounds bad because it sounds shady. But it's important to remember that the shadow banking sector also includes many things that we generally like to think of as good things, like microfinance institutions that enable people who are otherwise unbanked to have access to financial services, or specialized, say, infrastructure financing companies that provide important capital to support development. Now, why do people worry about shadow banking? Well, for starters, it has grown enormously since the financial crisis. If you look at the Financial Stability Board's narrow definition of non-bank financial intermediation, it's grown by about 8.5% a year and risen to about $51 trillion, representing about 14% of total global financial assets. It's grown incredibly quickly in some countries. One need look at China, where non-bank financial institutions have grown incredibly quickly. And it's also grown in India. And in India, we've seen a growth in non-bank financial corporations borrowing short-term, borrowing using commercial paper, and then lending for long-term projects. India had a sort of near Lehman moment in September of last year when one of the leading infrastructure finance companies, IL&FS, defaulted on its payments to lenders, and I think that made a lot of people nervous. Alongside this, we've seen a growth in non-performing loans in the banking system in India, and that's seriously eroded capital because banks have had to provision against those non-performing loans, and that has eaten into their capital and reduced their ability to lend and help the economy grow. And so the question really for the world, but in particular for India today, is what is the way forward? What should one do about the shadow banking sector, and how can one get the benefits while managing the risks? I would just highlight 4 lessons from my experience at the Bank of England. One is visibility. Just because shadow banking institutions are outside the regulatory perimeter doesn't mean that central banks and regulators shouldn't know something about what's going on. And that visibility means that you can at least try and assess when the risks might spill over to the rest of the sector. Second lesson is keep them away from depositors, come what may. Once you allow any financial institution to take deposits, the political pressure to bail them out should they fail is enormous. So certainly when I was at the Bank of England, when one heard of slightly exotic financial products being sold in the market, if they were nowhere near deposits and they failed, I didn't care, or we didn't care that much, because, as long as you had an orderly procedure for exit, it wasn't that much of a worry. And that one could usually, I'm not saying always, but you could usually, if they weren't too big and didn't have many connections to the rest of the system, allow them to fail. That brings me to the third lesson, which is avoid contagion to the rest of the financial system by making sure that the links to institutions that have deposits, that are deposit-taking, are minimal and managed carefully. Because, of course, shadow banks, if they are incredibly interconnected with the rest of the banking system, can cause huge amounts of contagion. And finally, orderly failure regimes, a way for non-bank financial institutions to be wound down if, in fact, they do fail, in a way that isn't contagious to the rest of the system and has no consequences for ordinary citizens and their deposits. And I think those 4 lessons have some potential implications for how to think about these issues in India.